What benefits are typically included with whole life insurance? I love how so many people just say, never buy whole life, without any idea of what your individual circumstances might be. It's true 90% of the time. A good, affordable term life insurance policy is going to be your best bet. Term life costs a fraction of what whole life does. If you have a family to protect and you and your spouse make an average income, yes, term life is the product for you. But be sure your term policy has a good conversion option, or preferably, options. That's a different discussion, though. Despite the naysayers, there are also some very valid reasons why a whole life policy may make sense for a client. Whole life insurance is a form of permanent insurance that typically offers 1. Lifetime coverage. 2. Guaranteed minimum performance. 3. The potential for higher growth. No, whole life insurance is not and should never be bought as an investment, because it's not one. Think of it as a leveraged savings account, instead. You can know, guaranteed, that at some point in the future, you can get all of your premiums back if you want to cancel the coverage. So, you have the leverage the death benefit provides. If you die, you get a whole heck of a lot more in death benefit than you've paid in premiums, and if, at some point, you decide you no longer want the coverage, you can get some or all, or more than, you paid into the policy back. So, when does whole life make sense? 1. I need lifetime coverage. I want to make sure I leave some significant bucks for my spouse, my kids, my disabled child, this is a huge problem, or a charity, whether I die at 50 or 95. Term ain't going to do that, folks. At the end of the defined term, the coverage doesn't end. Instead, the product automatically switches to maximum insurance charges and mortality charges, adjusted every year. So, that $500,000 policy you were paying $600 a year for, that you bought 30 years ago, suddenly increased to $7,500 at year 31, $8,200 at year 32, $8,700 for year 33, and so on. Not so for whole life. Your premiums are locked in for life. Or, you may have chosen a 10-pay or 20-pay plan, and you've paid it up and it continues to grow forever. 2. My spouse and I, or just me if I'm single, have maxed out our 401k, 403b contributions, and we make too much to contribute to a Roth IRA. Well, the cash side of a life insurance policy offers a good alternative to a Roth IRA. But, you ask, my Roth is for retirement income. How does whole life accomplish that? Well, if you get to retirement age and have a whole life policy with $250,000 of cash value and a $500,000 death benefit, you can borrow from your own cash value, within reason, to supplement your retirement income. When you die, your policy loan is paid off by the death benefit, the remainder of the death benefit goes to your beneficiary, and it's all tax-free. 3. Guarantees. If I put $10,000 a year into a Roth IRA for 20 years, what guarantees do I have that I'm going to have all my money at the end of 20 years? Unless you had your Roth contributions all in cash or money market funds, none. Remember 2008? Well, if you put $10,000 a year into a whole life policy, with guarantees, you know the minimum cash you'll have at the 20 years no matter what, and you may have far more, depending upon how the company performs. If your participating whole life policy pays decent dividends, your cash value may grow significantly. There are some really good mutual companies out there that paid 4 to 7% dividends in years when the stock market dropped by double digits. The main benefit of whole life insurance, sometimes called cash value life insurance, is to combine life insurance with an investment program that you don't have to do much about. In other words, you send the premiums to the life insurance company, they use part of those premiums to provide term life insurance, and the rest goes into an investment pool that causes your cash value to continue to rise over the years. This may appeal to you if you don't know anything about investing, don't want to know anything about investing, and don't want to be bothered with learning about investing. It also has the advantage that if you continue to pay your premiums each month, you won't be tempted to spend the money. In effect, it's a forced investment program. On the other hand, you are paying the insurance company to do your investing for you, and thus your investment return is likely to be significantly lower when compared with other options. That's because the insurance company makes a profit from managing your investment. The death benefit paid by a whole life insurance plan consists of your cash value plus whatever else is needed to provide the complete death benefit. So, for example, if you have a policy for $100,000 and your cash value is $65,000, then the term insurance portion pays the $35,000 difference and your beneficiary gets the full $100,000. By the time you reach about age 60 or so, the term insurance portion is usually less than 1/3 of the total because your cash value will typically have risen to over 2/3 of the death benefit. The guaranteed cash value amounts in most whole life insurance policies are based on very conservative investment assumptions, so that even in relatively bad times they will be able to fund the cash value. If the investments do well, they may also pay you dividends, which are, essentially, your share of the excess profits they made from their investments. So if you want to compare whole life insurance with other investment options, you have to include the dividends. But of course you cannot really know the dividends until after they are paid. There are also potential tax benefits for your beneficiary associated with life insurance, but whether and how much they benefit them depends on many factors. Usually they only really matter a lot for those who are very wealthy. When selling you a policy, the insurance salesperson will show you projections of cash value and dividends that make it sound like you are going to do very well by retirement age. But suppose you buy term insurance and invest the difference in the stock market. Chances are very good that you would do a lot better in terms of overall investment return. I, for example, have a small, whole life insurance policy that I bought when I was in my 20s and didn't know much about these matters. I also have various 401k and IRA investments that I made throughout my career. When I compare the results, it is clear that my whole life policy was not nearly as good an investment,